And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it's Thursday. It's the second best day of the week. Also means that Michael Leibowitz is joining me today. Talk a little bit about employment, recessions, the Fed. Of course, we've got another meeting coming up here next month. What do the recent CPI, PPI reports, kind of lay out for the Fed? More rate hikes, no rate hikes? Are we done? That'll be the conversation we'll have today. Of course, yesterday, markets kind of just held their own a bit. And again, we've had a very, very big run. We're going to talk about that in a minute, what that actually means, and as we get ready to kind of set up for the end of the year. But yesterday after the bell, Cisco reported earnings. Palo Alto Networks also reported earnings on the tech side. And this really kind of goes home to the point about this year in particular. So Cisco and Palo Alto Networks both missing estimates by a good margin. Both those stocks will be down very sharply today. Cisco will be down more than 10% this morning. Palo Alto Networks, same. But this has been a year where 7 stocks have pretty much, and we've talked about this before, have made up the bulk of the returns. Well, how much of the returns have those 7 stocks made up this year? Well, according to recent data from Goldman Sachs this morning, 112%. So if you take a look at the return of the market as a whole, so you take a look at the S&P index, we've had this really great rally so far this year. Markets are up like 15% for the year. 112% of that return has come from 7 stocks. In other words, the rest of the market has not really contributed much to those returns at all. And this has really been this bifurcation of how the market has worked this year. And again, this is as we look forward into 2024. Analysts are expecting a very big uptick in earnings growth as well as sales growth next year. And how is that going to be generated? Well, believe it or not, from 7 stocks. Entirely the next year, if you take a look at the earnings growth and sales growth for those top 7 stocks, they're expected to be up 11% next year. The rest of the market will have flat to negative earnings growth next year. So the entirety of earnings growth and sales growth next year will come from just 7 stocks in the market. So again, that makes it very difficult. And this has been this real problem we've had all year. We went through this yesterday a bit. We talk about the equal weighted index as an example. You take a look at the kind of the year-to-date performance. Absolutely nothing going on pretty much in that index as a whole, considering that it is about flat to where we actually started the year. So again, hasn't really done a whole lot. Small cap, mid cap as an example. Take a look at the Russell 2000 as an example of the small cap, mid cap space. Talked about that as well. Basically has flat for the year. So again, after, when you take a look at the performance of these other markets, the rest of Wall Street as an example, not a lot has gone on this year at all, considering that you have this very sharp advance in the S&P 500 that has really led the way. And again, we take a look at the NASDAQ index as an example. That's even a bigger example of this. You look at the year-to-date return of the NASDAQ relative to the rest of the markets. It's been very clear that, it's been a very challenging year for markets as a whole outside of just 7 stocks. So again, this has been the challenge. It's a challenge for investment managers, portfolio managers, fund managers, individual investors, retail investors, because again, it's been just a very narrow market in terms of what's performing overall this year. And again, as we go into next year, if we get into this cycle where again, you have 7 stocks generating the bulk of the returns, could we have another year of such a bifurcation? And that's going to be another very challenging year potentially for markets as we go forward. So again, I have no idea what's going to happen next year. It's always kind of a guess as to what's going to happen. But again, if you take a look at where earnings growth and sales growth are expected to come from, that really kind of pertains to how the rest of the year may work out. So again, we'll navigate this as we go, of course. But again, it's been very challenging, particularly challenging when you start talking about value versus growth. That's been a really tough year there as well. All right, let's talk a little bit about what you need to know before the bell this morning. So again, right now markets are continuing to kind of work through earnings season. This morning, Walmart reporting earnings, missed kind of their guidance and their estimates for the year. Stock's going to be trading down about 2.5% this morning. It's up about 13.5% so far. So this has been a good year for Walmart versus Target. Now, Target had a great day yesterday because that stock had been really, really beaten down. They missed earnings estimates, but it just wasn't as bad as everybody thought it was going to be. So, they got a boost from, even though they have weaker sales and declining sales, it wasn't as bad as everybody expected. So the stock was up about 20% yesterday. So a big move for Target yesterday after getting completely kind of pummeled. Walmart has had a really great return this year. Overall has been kind of climbing higher. But again, they're going to get hit this morning a little bit on weaker guidance going forward out for the rest of the year. But, translating this back to the markets, again, as we've talked about, we've had a very, very sharp advance here over the course of just the last few days, in particular, just since the beginning of the month. Right here at the end of the month, this was where everybody thought the market was going to do nothing but go lower. And we were talking about very negative sentiment. Everybody was bearish. And again, this is when you've got to be careful with markets. Since then, we've had a very, very strong advance. But now we're getting back to this pretty overbought level. And again, normally when we get to such kind of overbought extremes, you want to be a little bit careful here because the market's going to probably give you at least a little bit of a consolidation or a pullback. The MACD buy signal that kicked in, and this is an area that we had talked about a while. The MACD buy sell signal had gotten very deeply oversold. It's not overbought yet. There's still more room for it to go to the upside here. But it is starting to move up into positive territory. So again, we're getting pretty long in the tooth of this advance. So as we've talked about before, expect a little bit of consolidation or a bit of a pullback here to work off some of this more overbought condition. And that's going to give you a better opportunity to put some capital to work. So just be careful chasing stocks right here today. There may be some opportunities in stocks that are individual stocks that may be a little bit oversold or are turning up on a buy signal, whatever the case may be. But as the overall market goes, we're getting pretty extended. And this is really going to start to impact those top 7 stocks that are leading the way. Likely going to see them take a little bit of a breather here just as we kind of work into the end of the year. Now, again, a bit of a pullback here to support of any levels. We've got the 100-day right here at 4,390 on the S&P 500. You got below that the 50-day at 4,320 on the S&P. So anywhere this market can give you a little bit of a pullback here to support, work off some of this overbought condition, much better entry point to put some capital in for that year-end kind of Santa Claus rally as we get there. And again, the best opportunity most likely for that pullback is going to be post-Thanksgiving, first couple of weeks of December as we get those kind of normal cycles for mutual fund distributions. Every year they have to distribute all their capital gains, dividends, and interest. And there's about 20-25% of mutual funds that have to do that in the first couple of weeks of December. So that generally gives you a little bit of selling pressure on the markets. And that was something that it was also there's about 20% or so of mutual funds that have their year end in September, October. And that's one thing that was contributing to that weakness that we saw back in September, October. Again, we'll probably not get that type of weakness again, but a decent little downtick here in the market in the first couple of weeks of December won't be surprising at all. And that sets you up for that end of the year rally. And then the first 5 days of January, you get a lot of money getting put to work just as portfolio managers are getting ready and set up for the new year. So, kind of look for the opportunity. Again, just kind of pick your point, pick your stocks you want to own, and then wait for a little bit of a pullback to give yourself a little bit better entry point. But that's what you need to know before the bell this morning. When we come back, got a lot of stuff to get into with Michael Leibowitz this morning. So stick around. More of the Real Investment Show coming right up.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive. as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. Of course, it is Thursday. Michael Leibowitz joining me this morning, talking a little bit about, everything interest rate, inflation related. And of course, we've had a good bit of news on that lately. Excuse me. And, this has really kind of changed the dynamic of a lot of views and has been the big driver of the market rally here over the last, couple of weeks in particular. And so again, kind of going back to the end of October, markets are, declining sharply. Interest rates are going up. We're approaching 5% on the 10-year Treasury. Expectations are the Fed's going to, have to keep rates higher for longer, and inflation is here, and we're getting all these articles, and YouTube videos, et cetera, about the debts and the deficits, and we're spending too much money. That's why interest rates are going up, because nobody wants to buy our debt, and those were the narratives. 2 weeks later, the world's changed. Inflation came in, weaker than expected on the CPI report. PPI out yesterday, the producer price index, that was much weaker than expected as well. Retail sales are slowing down a bit. And all of a sudden, yields are falling, and it's now the Fed is now done hiking rates scenario. So, that's how and that's why you've always got to be careful. And again, we've harped a lot over the last 2 months about narratives. You got to be careful of these narratives that people come up with, because as you've seen, they can change very quickly, and that can really get you messed up, and particularly if you're betting heavily on these narratives on one direction or the other, it can really get you on the wrong side of the trade very quickly. But Mike, it's an interesting kind of situation we've got right now, because it's really a double-edged sword for the Federal Reserve. So yes, on one side, CPI is coming down, and we're looking at inflation rates at 3.3% on the headline. If we take out healthcare and rent, which are contractually fixed for most people, inflation's 2.6%. So, on the stuff that they spend every day. So, clearly approaching that 2% target that the Fed wants. The problem with that, though, is that markets are rallying. Yields are dropping sharply here. And we were below 4.5% on the 10-year Treasury just day before yesterday. And, that's easing financial conditions. Lower, you're already seeing mortgage applications tick up as 30-year mortgage rates come down. People are jumping out there to get their mortgage. You're starting, that and lower interest rates obviously help the consumer spending side, and that potentially, if you increase consumer confidence by higher rates and lower interest rates, higher asset prices and lower interest rates, people will feel good about going out and spending a little bit of money, and then the Fed's right back in the box again. So they've got a real challenge ahead of themselves.
Yeah, and so yesterday there were 20 Fed speakers. Think about that. 20 individual Fed speakers were out there opining on the economy, on monetary policy, bank regulations, whatever they were talking about. But interestingly, and I didn't be honest, I didn't see them all, but from all the headlines I did see, not one of them mentioned what you just said. Now, if you recall, 3-4 weeks ago, just about every single speaker mentioned that higher rates, lower stock prices were starting to really weigh on the economy. And we've seen a reversal of that. Not a big reversal.
Right.
Rates are still very high, but a reversal. And right now, there doesn't seem to be concern. So this gets back to something I think we talked about a week or two ago. Is there something that Powell knows? Is there something that billionaire investor Stanley Druckenmiller knows, that Bill Ackman knows? When Gunlock, they talk about this weakness in the economy. At least the investors, not Powell, that there's this underlying weakness that's grossly underappreciated. Might Powell appreciate that, and the Fed appreciate it, just not be able to say anything? So in a way, they may like rates coming down a little bit because it'll soften the blow. It'll make a soft landing, a little bit more of a possibility if the economy is really slowing down more than we appreciate it. And, like we said then, we don't see it, or at least in the economic data, forward leading indicators. There's certainly weakness or a weakening of the growth trends. But the question we need to ask, and my article from yesterday is on employment, because employment, in my opinion, holds the key to a recession or not. We're not going to have a recession if the labor market stays as strong as it is or as it has been. So when employment turns is when we're going to have a recession. And you can go back and look at the unemployment rate, and within months, 1, 2, 3 months, or sometimes even a month after a recession, unemployment rate ticks up sharply. And, I went through in the article a bunch of kind of leading indicators of unemployment. They're all showing changes in the trends. But the big question is, are we heading for a recession, or is it just a normalization, getting back to levels that are more in line with our longer term economic growth activity? So, kind of back to the big policy question, what's the Fed going to do? Are they scared about rates coming back down? And the answer is the economy is slowing, but we're not quite at the point where they should be overly concerned about the economy and give up their guard on inflation. So I think, they're probably going to try to steer interest rates and the stock market to just not go anywhere for the time being, and that may serve them well.
This is the big question. I mean, there was a Wall Street Journal article out yesterday talking about the elusive soft landing is coming into view, and this has been one of the interesting kind of dichotomies this year, I guess, or challenges, I actually should say, is that if you take a look at a lot of the leading indicators, the leading economic index, you take a look at the different measures of economic activity. There's the inverted yield curve as an example. The only time historically that we've had a quote unquote soft landing in the economy was in 1995. The Fed was hiking rates and we didn't have a recession, but the yield curves were not inverted in 1995. The economy was doing just fine. Every other time that there's been an inverted yield curve and the Fed was hiking rates, we had a recession. And it is interesting that there is such a large call right now for, this kind of economic nirvana where you have inflation returning back to 2% and no recession. Now, it's certainly possible. We should never, put it out there that it's not possible. And again, you take a look at the Atlanta Fed at the moment, their current economic expectations for quarter 4 are now just slightly above 2% growth. So clearly no recession. at least at the headline data. But, the one thing that always tends to get us is these, negative revisions later on. The National Bureau of Economic Research comes out and says, oh, yeah, the recession started a year ago. And we find out after the revisions that, well, it wasn't 2% growth. It was actually negative growth. We won't know that until we get there. But it is interesting that there's such a large call by economists for this soft recession, or I should say no recession, soft landing, versus last year where Wall Street economists were all saying that there was going to be a recession. So, it's very difficult to figure out what's going to happen just based, on the current economic data. But, this is why it's confusing for most investors.
But isn't that, if you're a Wall Street forecaster, isn't that the easy way to go?
Oh, yeah.
Because you're kind of right in both scenarios. And that's, at the end of the day, that's kind of their goal, to be more or less right. So if you go into a recession, they say, yeah, we thought there would be a slight recession. It was a little deeper than we thought. If the economy is a soft landing and we don't go into recession, just the economy slows a little bit, it's what we call the Goldilocks scenario. And, so I think they're kind of putting themselves in the right position to be quote unquote right. Mm-hmm. It's not gutsy. It may or may not really be their true views, but, and I think there's a lot of pressure on the banks who employ these analysts to say certain things and to support certain Fed views because they are, kind of joined at the hip. So, like equity analysts, economists are the same thing. You have to take everything they say with a grain of salt. I mean, if you look at stocks, how many stocks have a sell rating?
Right.
They're what, 3? I mean, there aren't any, right? They're
well, yeah. If you rate a company's stock with the sell rating, they don't want to do investment banking business with you, which is where all your money comes from. So yeah, you always keep them rated to buy.
Right. If the Goldman Sachs said we're heading for a very deep recession and I fear that we're going to be in a depression, how many of their clients are going to do business with them?
Exactly.
None.
Yeah.
None. They're going to go to Morgan Stanley, who has this bright, cheery outlook.
But and it's funny, we joke about it, but most people really don't understand, that's how Wall Street works. Is that if you take a look, and we've done reports on this previously. I probably should update one and put it out. But if you take a look at the how where investment analysts get their compensation from and get their reviews from. It is all about their institutional clients, making sure those are happy. Retail investors are at the very bottom of the list, right? They don't care about retail investors. They don't care if you make money or not, even though you've got your money invested with them. They don't care about you. They only care about their institutional clients. So again, that's why you have, the vast majority of ratings on companies are always a buy. And it's always interesting, right? I remember back in 2000, Lucent Technologies, as an example, was rated a buy all the way down to like $3 a share before it went bankrupt. So, it's you gotta really be careful with those buy ratings because they really don't mean much of anything. All right, quick break. Come back. Got a lot of stuff, more stuff to get into with Michael Leibowitz. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
The bets are on right now for the NVIDIA drinking game.
The Real Investment Show podcast.
Every time NVIDIA says the word AI, you have to take a shot.
Same show, your schedule.
By the time they get through the earnings call, half the country will be completely obliterated and it really won't matter what they say their earnings were, which will be just in time for the debates. Exactly.
At realinvestmentadvice.com.
That's a whole other drinking game right there.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now, with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Excuse me. Well, welcome back to the show this morning. I choked myself up. Michael Leawood's joining me as well. So I want to, Mike, I want to step back a second to talking a little bit about, we've had this very strong rally in the market and we've had this drop in interest rates. And as I was saying earlier, that eases financial conditions for consumers, right? And so the whole point, and we've talked about this so many times in the past, I feel like I don't have to reiterate it, but I'm going to anyway. Just in case you haven't watched the show before. And if you're new to the show, we appreciate you. Please subscribe to the show and click that little bell icon there. We appreciate it. But the reason the Fed hikes rates is to tighten financial conditions so that consumers will stop spending money. And I'm making this very simplistic. And that slows down demand in the economy. That brings down inflation, also slows economic growth. So, that's why the Fed hikes rates. When the markets rally sharply and you have a drop in yields, that loosens those financial conditions because my 401k plan balance went up, so I feel better about myself, so I can go spend a little extra money because I have more money in my investment account. Yields are falling, so things are getting a little bit cheaper in terms of financing, credit card debts, those type of things. So I kind of feel better in that environment to go spend a little bit more money. But that works against what the Fed's trying to do because now consumers go out to spend money. That creates demand. That creates inflation. So it's this really interesting situation the Fed's got themselves into by, talking about higher for longer and this whole, even Powell just recently said, hey, we don't have really inflation back to our target yet. So we're still very aware of that. And yet markets are kind of front running them now, expecting them to cut rates. So, I mean, if the Fed's done hiking rates, and according to Nick Timrose, the Fed's last rate hike was in June. And so now the next step for the Fed will be to cut rates. And the markets are now betting the Fed's going to start cutting rates in March of this year, at the earliest. So, unless the economy's in a recession, why would the Fed cut rates, which would, potentially re-spark inflation? It's a very interesting situation between this debate between the markets and the Federal Reserve. What do you think?
It's kind of a guess, right? I mean, for the Fed to cut rates, inflation, I think, has to be at 2% or below and clearly trending lower at that point. And the economy has to be clearly showing signs of a recession.
Yeah,
so,
let me stop you there real quick, because I think that's an important point. If the Fed's not going to cut, if inflation's hovering at 2% or maybe slightly below 2%, just kind of holding on, I don't think the Fed's going to cut rates. To your point, the reason the Fed's going to cut rates is if you've cut through 2% and inflation is showing real signs of potentially becoming deflation or negative inflation, that's the one thing the Fed doesn't want. And that's why the Fed would cut rates, would try to stem that by getting activity started back in the economy, right? So they've got to be looking at a more dire situation with inflation and the economy in a recession and saying, okay, I better ease up this tension so I can get consumers back out there in the economy and get them to start buying stuff.
And Lance, let me back up too.
Sure.
I think it's important to define what we mean by the market thinks they're going to start cutting in March. So Fed funds are what the Fed controls, and Fed funds are just loans between banks on an overnight basis. And that's sort of the basis for banking. That banks are very active in those overnight markets where they borrow basically overnight. Some lend, some borrow, and that rate kind of is the rate the Fed manages. The Fed doesn't say Fed funds are at 5% and they trade at 5%. The banks interact among themselves and it trades where the supply and demand warrant it. But to help keep it at 5%, the Fed is always putting money in, taking money out of the overnight markets to try to target it at 5%. So that's the targeted rate. Mm-hmm. And that's how basically the Fed does their job. Everything else the Fed does is via words trying to move the rest of the yield curve. So overnight rates don't affect me or you. What affects us are 5-year car loans, 7-year car loans, mortgage rates, credit card rates, which are, monthly rates. Corporations too are not active at all in the overnight markets. So they use the Fed funds market to try to persuade the rest of the yield curve and try to limit or expand how much banks are willing to lend or lend on any given period. So it's important to think about that. So you have Fed funds, and then the Chicago Mercantile Exchange has Fed fund futures. So those are just futures. It's a bet on where Fed funds will be in the future. And they have a contract for every month going out, I think 2 years. Mm-hmm. The most active ones are about 6 to 9 months from the current date. So right now you can go out and say, well, what's the February Fed funds future at? And depending on where that's at versus where Fed funds are now, that tells you where traders are leaning as far as what the Fed may or may not do. And you can then assign odds to it. So Fed funds today are 5.25, and let's just say the March contract is 5%. Well, you can say 100%, the market is betting the Fed will cut rates by 25 basis points by March. But that's just a bet. And those numbers move around a lot. If we would have had a very high CPI number, what was an easing could have easily gone to the Fed's going to hike more.
Right.
So it's important to follow them because understanding what the market thinks is incredibly important. But we also have to realize they can swing pretty rapidly. They're volatile. And they're just the aggregate expectations of the market.
Yeah. So, and that's right. And, I think the thing that, as an investor, the thing you've got to be aware of is, let's assume that, just for a moment, Mike, that we get through this year. We're now into January, February, March of next year. Markets are up, 5-6%, in the beginning of the new year. We're having another kind of start to the year like we had this year. Yields are close to, say 4%-ish on yields. And the economy's doing great. Why would the Fed cut rates in March? Right. Just assuming that's what, I think what's important is that, for the markets that are betting on the Fed to cut rates, if everything is fine, right? If everything's doing okay, if the markets are doing fine, yields are doing fine, the economy's, growing at 2 or 3%, there's no financial stress in the banks whatsoever. The credit markets are functioning. Right now, there's no, you take a look at credit markets, there's no sign of any type of financial stress in the credit markets. If everything's fine, the Fed just goes, I'll leave rates at 5% because apparently it's all good, right? There's no reason to cut rates lower until there's some event that happens. And so if we're expecting a soft landing and no recession scenario next year, there's no reason to cut rates. The Fed's going to hold those rates where they are and then cut them when there is a recession.
Certainly not in March.
Yeah.
So this is a great conversation, because earlier we were talking about how the economists who sell stocks for a living are talking about a Goldilocks scenario, yet the market is pricing in Fed cuts starting as early as March. Mm-hmm. And I think they're priced for 1% of Fed cuts throughout the year.
Right.
So the market, which is people putting money to work, is telling you that they think there's going to be a light recession. Mm-hmm. Because if the Fed only cuts 1%, that's slow economic. That's not a bad recession. The Fed typically goes all the way back down to 0, which would be a 5% plus rate cut. So the market's telling you there's going to be a slight recession next year, and Wall Street's telling you, it's going to be perfect, soft landing, Goldilocks, the whole 9 yards. So that's where looking at what the market's telling you versus what you're hearing from the media and Wall Street are very important to see when they diverge and how much they are diverging by.
Yeah, and this is an interesting point, because say, well, Lance, and I want to bring this up after the break. In 2019, the Fed cut rates back to 0, and there was no recession, and everything was just fine. So why was the Fed cutting rates to 0 then? And it's a great point. So when we come back from the break, we're going to revisit 2018, 2019, and talk about what was going on, because Mike brought this up earlier. What does the Fed know that we don't know? And maybe that's something we need to delve into a bit more, because that's something that could be the case as we head into next year, particularly with the way the Fed is starting to change their tone a bit here. And coming up at this December meeting, Nick Timrose is talking about a reworking of the Fed statement to start implying that the Fed is now done cutting rates. So we'll talk when we come back from the break. We'll pick up with Michael Leibowitz. We'll talk about all that. Mike's latest article out on the website right now, realinvestmentadvice.com. Get his latest article, and if you're watching the video, be sure and subscribe to to our show and click that little bell icon. We appreciate it. We'll be right back after the break with more of Michael Leibowitz on the Real Investment Show. Don't go away.
Daily investment news you can use. Delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the show this morning. So, talking a little bit about the Fed, cutting rates, and normally when they're cutting rates, there's a problem in the economy. Either, you're looking at a recession or some type of financial event, etc. But we have to go back and revisit 2018, 2019 as an example, because the Fed cut rates to zero in June, July of 2019, very rapidly. And there was no recession. Clearly evidence that the Fed can cut rates out of the blue without any type of recessionary impact. And, as Mike said earlier, the Fed has data that, they're driving monetary policy with. And, one of the issues is, what do they know, right? Because they're so interlinked to the banks. What do they know that we don't know? That type of situation. So let's go back and revisit 2018 really quick. So June, July, August, September of 2018, the Fed's hiking rates. And in September of 2018, Jerome Powell comes out. It's the September Fed meeting, and he makes a comment. He says, we're nowhere near the neutral rate. And the market just freaks out. And we start declining, and we fall 20% in the markets between that September meeting and the end of December of 2018. The markets are down 20%. Because the market's now pricing in the Fed to continue hiking rates to this kind of unknown level of, whatever the neutral rate was. Of course, at that time, President Trump's in office. He's starting to weigh in heavily on the situation. The markets are coming down. He's like, I don't understand why the Fed's not, is not responding to this. And there were basically calls for President Trump to fire Jerome Powell, the whole nine yards. And, the call at that time was, Jerome Powell's a different animal. He's a different animal than normal Fed, the previous Fed chairman like Yellen and Bernanke that were more kind of the puppets of the administration. He's his own man. Well, then in 2018, at the end of 2018, he completely reversed course. All of a sudden, we're at the neutral rate in early December at the Fed meeting. He says, oh, yeah, we're a lot closer to the neutral rate than we thought we were a couple of weeks ago. And by the course of June, July next year, rates are now back to zero. But again, no sign of a recession. So why was the Fed cutting rates? Well, we didn't know it at the time, but there was a problem brewing. And in September of 2019, the Fed has now launched this massive reverse repo market. Mike and I were on the show in September of 2019 explaining this whole reverse repo thing. Mike was using an example of, this is overnight collateral where people are putting up treasury bills, government guaranteed bonds. It's like parking a brand new Mercedes in your driveway saying, hey, can I borrow $10,000? Here's the key to my Mercedes as collateral. If I don't pay you back, you get to keep the Mercedes for 10 grand. And that's what was going on. There was these the completely abnormal rates being charged for overnight loans. Couldn't figure out why it was going on. We find out later that there was a lot of stress in the hedge fund market. A lot of these big hedge funds like Citadel were running into problems, but we didn't know it then. And then, of course, we were talking about September of 2019. Hey, there's all these recessionary indicators coming. We've got all these recessionary indicators. No sign of a recession. March of 2020, we have a recession. So the question becomes, again, the Fed cut rates at a point in time where we didn't think there was a problem, Mike, but there was a problem brewing below the surface. It just hadn't manifested itself yet. And, this is one of the things I think we have to be keen on, and that, we may get into a position next year where the Fed does cut rates. We don't see any type of economic data that suggests that there's a recession or real risk, but there may be a problem brewing under the surface from this lag effect of these previous rate hikes, which is kind of what we saw in 2018, 2019. Your thoughts?
Right. It's very interesting comparing what happened 2016 to 2019 versus what's happening now. So Janet Yellen actually started raising rates in early 2016, and they ended raising rates. They brought them from 0 to, I think, 2.5 by late 2018, and then they paused. So rates were being raised for 3 full years, and then 6 months later, you have a big problem. And signs that a recession was coming, certainly slowing economic growth. So again, the lag effect takes a long time for interest rates to affect the economy, but when you have an economy driven so heavily impacted by interest rates, it's bound to happen. So the Fed started lowering rates. They created this repo program to save the hedge funds and ultimately to save the banks, not the hedge funds. And then, the problem with that period is, yes, we had a recession in March, but it was how much of it was pandemic, and would there have been a recession if we never had the pandemic? So it's kind of the unknown on how that would have played out. But that what happened back then seems more of a Goldilocks type scenario than what we have today. The Fed started cutting rates before the economy was slowing. They may have been able to cut it enough to slow to make sure the economy didn't go into a recession, but we'll never know. So this time, rates more than double what they did last time. Last time they went up 2.5% in 3 years. This time they've gone up over 5% in half the period. So you're like, well, if we have an economy driven by credit, why doesn't the cost of credit or interest rates matter? And they matter significantly. But you had such incredible stimulus in the system just masking over, making it irrelevant for the short term. But you're starting to get stresses in the system, right? We saw the March banking crisis. And I think it was Mester yesterday who made a comment that basically said the banks are not out of the woods at all, and they're one potential event from being back in trouble. So there are clearly stresses in the system, and an economy that has a long run growth potential kind of in the 2% or even less range that's so heavily dependent on credit can't afford 5% interest rates. It just doesn't work. So, we're going to see now, there's no pandemic and massive stimulus to kind of hide what would have happened. So, I think what the Fed is grossly aware of is that we're at interest rates that will, I'm not going to say will induce financial stress into the system. So, when they see stress, they're going to have to take actions. And the fact that they haven't lowered rates means that they don't see enough stress to warrant their taking action. And they're trying at the same time to remain firm on fighting inflation. But, if the Fed sees something, they're going to cut rates, and we're going to be stunned because we don't know why, just like we saw in 2019. So, looking at the two most recent Fed rate hikes are very instructive as to what we might expect going forward.
Yeah, and I think the thing that we can watch as as individuals and as investment managers, et cetera, we can watch liquidity indexes. We can watch kind of how things are functioning in the underlying financial markets. Keep a watch on credit spreads, those type of things, because those will be really good early warning signs that something is starting to break somewhere. And particularly if we start to see the Fed cut rates for any reason, we should see some relative indicators in some of those areas that are suggesting is like, oh yeah, this is why they're cutting rates, and this is probably going to lead to a bigger problem if this doesn't resolve itself fairly quickly. Credit markets are pretty good about forecasting these situations. And again, I kind of find it interesting that as fast as rates have risen, with the Fed, that we haven't seen more. There seems to be no real worry in the credit markets, even in some of the more lower tier rated kind of bond indexes.
And that may be why the Fed feels comfortable with this higher for longer, and we don't have to do anything at this time. Yeah. That there really are no stresses. But just because there are no stresses doesn't mean there won't be no stresses, right? Yeah. There were stresses in March, and there certainly will be if rates stay where they're at. It's a question of when. And kind of going back to what we were talking about with Fed funds, if they're pricing in a 50% chance of a 25 basis point rate cut in March, they're telling you that they think by March we need to hedge ourselves a little bit that something doesn't break. It's not a big bet. And again, it's only a 25 basis point rate cut and a 50% chance of that. But, I think there's a lot of investors that are saying, what, the environment is ripe for a storm. Whether that storm happens in March or July or next December, we don't know. But we should probably put a couple chips down on the into that hedging category and bet that the Fed will be lowering rates by then. And it's probably a lot of those bets are not because they think inflation will be below 2% and Goldilocks. They're because of probably something breaking.
Yep.
As you go later into the year, that's when you start getting into more of the economic-based rate cuts.
Yeah. So, yeah, it's going to be very interesting to see. And again, we'll have a lot to talk about. The next Fed meetings, just coming up in December. So it's not that far away. And again, it'll be very interesting to see if the Fed and Jerome Powell in particular changes his statement much from what we've seen before about inflation being their primary concern, or if it's now becoming something more relevant. I think if they ditch that inflation statement, that they're probably more concerned about the economy than we actually think. So it'll be very interesting. We'll have a lot to talk about when we get there. Michael Lee Woods, be sure and get by his website, by our website today, realinvestmentadvice.com. Get his latest blog post. It's out on employment. And of course, as always, send us your questions and comments, what we can do for you at the website, realinvestmentadvice.com. Have a great day. We'll see you back here tomorrow for Financial Fitness Friday with Danny Ratliff and Richard Rosso. See you then.